Risk management in stock trading, key strategies for success. Investing in the stock market presents an exciting opportunity to grow your wealth, but it also involves significant risks. Effective risk management is crucial for any trader or investor looking to preserve capital and achieve long-term success. Without a sound risk management strategy, you may face substantial losses that could undermine your financial objectives. In this video, we will delve into 3 essential components of risk management in stock trading: determining your risk tolerance, using position sizing techniques, and implementing proper diversification. By understanding and applying these strategies, you can mitigate risks and make more informed trading decisions. Determine your risk tolerance. Understanding your risk tolerance is the foundational step in managing risk. Risk tolerance refers to the degree of variability in investment returns that you are willing to endure. It is influenced by factors such as your financial situation, investment goals, age, income stability, and your psychological comfort with risk. Example 1. Young professional with a stable income. Consider a young professional named Sarah, who has a stable job, no dependents, and a long investment horizon. Sarah is in her late 20s and earns a steady income, which covers her daily expenses and allows for regular savings. Because she has many years ahead to recover from potential market downturns, Sarah can afford to take on higher risks. She might choose to invest a significant portion of her portfolio in growth stocks, which, although volatile, have the potential for high returns over the long term. Example 2. Retiree living on fixed income. On the other hand, imagine John, a retiree in his mid-60s who relies on his investment portfolio for his living expenses. John's primary goal is capital preservation, as he does not have a regular income stream apart from his investments. His risk tolerance is low because any significant loss could affect his standard of living. John might prefer a conservative investment approach, allocating more of his portfolio to low-risk assets such as bonds or dividend-paying stocks that provide steady income and preserve capital. Assessing your risk tolerance involves a thorough evaluation of your financial situation and personal comfort with risk. This understanding helps you align your investment strategy with your ability to endure market fluctuations, thereby reducing the chances of making impulsive decisions during market volatility. Use position sizing techniques. Position sizing is a critical aspect of risk management that involves determining the appropriate amount of capital to allocate to a particular trade. Proper position sizing helps minimize the impact of a single losing trade on your overall portfolio, thus protecting your capital. Example 1. Fixed percentage risk model. One common position sizing technique is the fixed percentage risk model. This approach involves risking a fixed percentage of your total capital on each trade. For instance, if you have a $10,000 portfolio and decide to risk 2% per trade, you would risk $200 on each trade. This method ensures that no single trade can cause a significant loss to your portfolio, providing a buffer against large drawdowns. To apply this model, you first need to determine your risk per trade. If a stock you want to buy is trading at $50, and you decide to set a stop-loss order at $45, your risk per share is $5. Given your risk per trade is $200, you can buy up to 40 shares, $200 for $5 per share. This disciplined approach helps manage your risk effectively. Example 2. Volatility-based position sizing. Another effective method is volatility-based position sizing. This technique adjusts the position size based on the volatility of the stock, ensuring that your risk exposure remains consistent across different trades. For example, you might invest smaller amounts in highly volatile stocks and larger amounts in less volatile stocks. Suppose you have 2 stocks. A and B. Stock A has an average daily range of 3%, while stock B has an average daily range of 1%. To manage risk, you could allocate a smaller position to stock A due to its higher volatility and a larger position to stock B. This approach helps ensure that your risk is proportionate to the volatility of each stock, preventing outsized losses from highly volatile investments. By using position sizing techniques, you can better manage your risk exposure and protect your portfolio from significant losses. These methods provide a systematic approach to investing, helping you stay disciplined and avoid emotional decision-making. Implement proper diversification. Diversification is the practice of spreading investments across various assets to reduce risk. A well-diversified portfolio can help mitigate the impact of poor performance in any single investment, providing a more stable return over time. Example 1. Sector diversification. Investing in different sectors is one way to achieve diversification. For instance, instead of concentrating all your money in technology stocks, you could spread your investments across various sectors such as healthcare, finance, consumer goods, and energy. This way, a downturn in one sector, such as a technology slump, won't devastate your entire portfolio. Imagine you have a portfolio with 25% in technology, 25% in healthcare, 25% in finance, and 25% in consumer goods. If the technology sector experiences a 10% drop, only 2.5% of your overall portfolio value is affected. This diversified approach reduces the risk of substantial losses due to sector-specific downturns. Example 2. Geographic diversification. Geographic diversification involves investing in stocks from different countries or regions. By holding a mix of domestic and international stocks, you can protect your portfolio against economic downturns in any single country. For example, if the US market is underperforming due to economic challenges, gains in European or Asian markets might offset those losses. Suppose you allocate 60% of your portfolio to US stocks, 20% to European stocks, and 20% to Asian stocks. If the US market declines by 10% but the European and Asian markets rise by 5% each, the negative impact on your overall portfolio is minimized. Diversification reduces the risk associated with investing in a single market or asset class, enhancing the stability of your portfolio's returns. By spreading your investments, you can navigate market volatility more effectively and achieve more consistent long-term growth. Conclusion. Risk management is a fundamental aspect of successful stock trading. By determining your risk tolerance, using position sizing techniques, and implementing proper diversification, you can effectively manage the risks associated with trading. These strategies not only help protect your capital but also provide a more stable path toward achieving your financial goals. Embrace these risk management practices to navigate the complexities of the stock market with confidence, ensuring a more secure and prosperous investment journey.